Real true education, not fake news. It's the 28th of June 2020. Good night. This is video number 11I. That's an I with a dot on it. And it's on auditing. A theme of these videos is counting and the ability to count and how to use counting, and auditing is central to that. So it's 11I, auditing and companies, auditing companies. If I don't get it done in a reasonable time, I'll split it in two. We do it in two. Okay. So the first thing to remember about auditing is that a company, it being usually a limited company, is a separate entity to the owner or to the directors. When I say the owner, I mean in the case of a sole trader or an individual who's doing business or doing economic activities. When there's a company involved, it's limited by the value of its shares. And shares represent the ownership of the company. So, for example, if I had a good hardware shop in the middle of Carrickmacross and I'm getting on in years and I want to retire, I might well turn it into a company and then sell the shares. If I turn it into a company, I would retain all the shares if I'm the owner of it. So there might be maybe 1,000 shares, and the total value of the shares would equal the value of the company. And so those shares could be sold, and instead of me running it, there'd be a manager, a CEO, and there'd be directors. Now, so it's limited by the value of its shares. And this whole concept goes back into the 1800s, when it was realised that if private individuals were liable for the debts of a company, well, nobody would probably take part in running a company. They'd all, nobody'd risk losing all they own if the company, one of their companies happened to go bottom up and couldn't pay its creditors. So that's why the company law is there. But then it's often abused. It's often abused where people take advantage that there's no risk to them. And so that's the thin line that has to be drawn between the two. So the shareholders own the company, and the directors manage it. And there's normally a CEO. There could be 1, 2, 3, 4 directors, depending on how big a company it is. And they will have to file annual accounts, because the corporate veil is what is the name applied to the fact that if you run a company, you're only liable to the value of the shares of the company, or the value of the company. And because of that, the state insists, in nearly every country I know of, that you submit accounts to show what you're up to. That's the price you pay. You give away your privacy to what you're doing and to your activities in order to get the protection of the law in relation to going bankrupt or being unable to pay your creditors. So again, there'll be annual accounts, there'll be directors, and there'll be sometimes an internal auditor. So a good company will have directors and it will have an internal auditor. I don't think they're all that common nowadays. Many just use maybe a member of staff to keep an eye on things, but it's good housekeeping to have an internal auditor. And the internal auditor is responsible to the directors only. They're responsible for keeping an eye on things and informing the directors. But they're indirectly responsible to the shareholders as well, and to everyone else, to make sure things are done right. I don't know how many companies have them. Some of the bigger ones do have them. It's considered good housekeeping, but there is no law that I know of that insists on there being an internal auditor. And if the company is a decent company, there's not much need for one. If a company is a crook, if it's run by crooks, as a certain number of them are, then the internal auditor will come under pressure and will probably have to be a crook him or herself in order to get appointed. So it's a mixed bag. So large companies must engage an external auditor. Now an external auditor is a totally different thing to an internal auditor. The Companies Act in Ireland and most countries insist that not only that the directors are responsible for the accuracy of the accounts and that they give a true and fair view, but that the auditor must also certify that they give a true and fair view. Now again, the law says that the directors are accountable, and there's a lot of law to try and make them and pin them down to make them accountable. So the auditors are responsible for certifying that the accounts give a true and fair view. Now any auditing company will audit a lot of companies. There's not enough money in it for them to watch every move and be there all the time. They come and they do certain tests, certain samples are taken, and then they form an opinion. Now the company accounts must have a profit and loss account, a balance sheet, and notes of the account. They may have a cash flow statement. The notes of the account will explain what's contained in the profit and loss account and what's contained in the balance sheet. The profit and loss account is really an account for the year's trading, what it received and what expenses it has. And the balance sheet is a snapshot at the year end, just the last hour of the last year. Everything could be rosy on the 31st of December, and on the next day at 2 o'clock, on New Year's Day, it could go bankrupt. So it's a snapshot. It's like if you looked at a scene and you took a photograph. Whereas the profit and loss account is the whole year's trading. Now, so central to compiling a set of accounts is the valuation of the assets. What value is the assets? That's cash in the bank, money they owed, money they owe, land, buildings, machinery, all that type of thing. So what assets they owe, and that can be also goodwill, it can be maybe rights of way, it can be some agreement, whatever. So an example would be where maybe before I would get rid of my company, I might have goodwill from some other company, or I might have some arrangement that is very advantageous to my company, and that's an asset. It's an intangible asset in that case. So the valuation of assets is important. And in a set of accounts, if the valuation of the assets goes up, it is the same as making a profit. So a company that has no profit could actually show a profit by increasing the value of the assets because they're richer, because their assets are more valuable. And on a farm, that's happening with calves and young cattle and all that. They're increasing in value. Even though you don't sell them, they're increasing in value. So now we see that in recent years, about in the last 10 years, a new concept which used to be banned is fair value adjustments. And it used to be that you would value your assets and you could adjust the value of an asset by a process in the accounts where maybe a building would become a bit more, something happen it, or there'd be an earthquake or something would happen like that, or various valuations can change, and there was a process for doing that in any set of accounts, and there has to be a process, but in recent years they allow a wider way of doing it, a fair value adjustments, which allows the opinion of the directors to come into it, and the directors can fraudulently and wrongly state that the company's gone way up in value and therefore get a higher profit, and then they can show that to the bank, and the bank will give them a loan, and they can stuff the half of that in their pocket, and the rest is history. You know the rest. So it's not a good thing. And in the book Bean Counters on all this economic activity and recessions and all that sort of stuff, the author blames the legalisation of fair value adjustments for many of the ills of the corporate finance world. Now, when it comes to the audit, and this is the external auditor, Lord Denning, this is a fella, he was a British master of the rolls, and he was the guy that he fell foul of Republican nationalists for some judgments he gave regarding alleged terrorists in England who had Irish connections. But he was a Welshman, and he made the point, which sticks in law and is a very important point, that the auditor is a watchdog, but he's not a bloodhound. I think that speaks for itself. That was his view of an auditor. They're a watchdog, but they're not a bloodhound. Now, one of the things that guides the compilation of accounts is the financial reporting standards. And in Ireland, they're made jointly with the United Kingdom of Great Britain and Northern Ireland and Ireland. We tend to do it the same way. It's not unfair. Everyone gets a say when they're making up one. It's just to have it uniform. Now, there is one of the effects of Brexit that I won't tell you. I think now that the European Union may not allow the common standards between Ireland and the UK. That's something to watch for, and just shows you one of the snags. But so far, it's a common one between the UK and Ireland, and eventually, I suppose, and even maybe yet, Europe, at the moment, Europe will be able to set these standards as well. But slightly different financial reporting standards in Europe and America, but not a lot. It's still all generally use the same type of system, because it's the double entry accounting system, and it goes way back to ancient Greece, and I for one cannot think of a better way of counting than is done by the balance sheet and profit and loss account. And so auditors then, when they're doing an audit, they must keep notes, they must use the right procedure, and they also have a concept known as audit risks and audit evidence. And because they can't audit every document and every invoice, they select samples. And for example, if you're doing a hardware store, large hardware store, the auditor might decide to check the cement coming in and its sales, and go through it very, very meticulously. And he might find nothing really wrong. You might find a few mistakes here and there, but nothing serious. Now, maybe if he had checked the wood, the timber, he would have found something serious. But he can't check everything. And so the concept of audit risk is the risk of picking the wrong sample or making an error that the risk is there. And he has to assess that risk. So that's audit risk. And then there's, as I said, there's audit evidence. So for example, if he was doing the cement and he found some common mistake being made in invoices, he might check with the person who brings them in or who checks them in and discovers that he had a particular way of doing it. There mightn't be any fraud involved at all. It might be that he regards two different types of cement and two different makes, and they have different values, and he might get that straightened out. That's audit evidence. Or he might have a letter from the cement company to say that they were supplying cement at a cut price or something. Some bit of evidence to back up his findings, and also to back up the audit risk, to show that it's not just a blatant, simple sample, that there was a little bit more cross-checking involved to do a good job, bearing in mind that the auditor cannot check everything. The next thing is a good company should have an audit committee. Audit committee should be in a company. Again, this is proper housekeeping. And many of the good companies I have named here, and the Irish good companies and UK good companies, this goes as standard. But not all of them do it. And you might say, well, they should be made do it. Well, we all keep accounts, and I can tell you, it's very often the shoebox under the bed. It's not all that easy just keeping everything right when you have cows calving and silage to be made in bad weather. It's not easy doing it, but at the same time, the honest person will have consistently make an effort, and there'll be no effort to defraud. And it's really if there's fraud involved that the problem arises. Now, if we look here at an example, Ernst & Young, one of the main auditors in the world, gave Lehman Brothers a clean bill of health. They give them a clean bill of health, Lehman Brothers in America, the year before the 2008 economic collapse, despite the fact that it was actually a basket case. Now, that shouldn't happen, and that's considered bad practice. But I give it only as an example. So, the question then arises, why have auditors at all? Why have them at all? You can't pin them down too easily for bad work. And why pay for them? Well, of course, an awful lot of audits are good and done well. There's good housekeeping. They probably do a good service, and they're an extra expense on a company. You're paying for them when you buy something of a company. So it's an extra check, because the whole process of compiling accounts is very subjective. Now, one of the things about disasters and collapses and audit failures are they always seem to happen when there's a downturn. They seem to happen when there's a downturn, not when things are going up, because companies are more vibrant during a rise, when things are going up, and when the assets. And I have said a downturn is really when it's realised that the assets aren't valued what they were in the books, and so. When there's a depression or a recession, then we see companies collapse, and that has been my experience, and that bears out my claim that about the valuation of assets being so central to economic activity all over the world. Now, the auditors cannot be expected to find every error and every fraud. They can't be expected to know everything. There could be a member of staff there who's pocketing a little bit of money now and again, and it can be very, very hard to do it. But if the directors are active and doing their job, they too will employ the correct managers, and this will be discovered. So it's generally sloppy management and sloppy, careless work that causes these things to happen. Somebody starts to take advantage of them. Another issue is that the revenue commissioners, they seem to be able to come in and do an audit. I tell you, you won't get by them boys if they arrive. So there's this horror of the revenue coming in to do an audit. But that's because they can go into it in more detail. They have more time. They're paid for by the public. They don't have to worry about where they can get the next job. So again, we have to be reasonable about it. So with that in mind, I'm going to break up this video on 17 minutes, and we'll be back. We'll be back again for hopefully part 2, and I'll get it done immediately after this, just to give it a little break. Is that okay? So we'll see you back then. Thank you.